You're deeply involved in Blackstone's new effort in insurance. Tell me about it.
Well, we started Blackstone Insurance Solutions earlier this year, and we think it's a big opportunity for the firm. There are about $23 trillion of assets on a global basis housed by insurance companies. The vast majority of that, about 70%, are in fixed income products. So what we're trying to do is help insurance companies invest all that capital in products that give them incremental return or less correlation to what they can find in the public markets.
The total addressable market, as you just said, is massive. How big a business could it be for Blackstone?
Well, our president and chief operating officer, Tony James, I guess John has now taken over that role, but when we announced our first quarter earnings, I think he said he expects it to be a $100 billion business.
Yeah, a lot of folks think that's conservative, given the fact that, as you just said, there's $23 trillion of potential assets there for Blackstone. $100 billion is just but a small fraction of that.
True. However, there are also lots of restrictions, guidelines, and diversification that these insurance companies need to pursue. We're highly focused on the alternative sleeve, which today is approximately 5% of the total assets. Now, I think we can be relevant in some of their investment grade allocations as well. We have a unique scale across our private equity, real estate, and credit businesses to manufacture fixed income and credit products. And the key is really trying to solve their particular unique investment needs.
So if you're successful, 5 years from now, it could be what?
Well, I think Tony thinks in terms of 5 to 7 year timeframes. He's probably closer to 5 on this $100 billion. We do have a great advantage that we start life off with about $23 billion already at the firm. So I think it's entirely plausible that over the course of 5 years, we can get to his target. I will point out, he's usually right when it comes to these predictions. So that's certainly what we're focused on.
Well, that's partly because he makes certain that he is right. How is creating credit product for insurance companies different from what you do at GSO right now?
Well, right now we have various LPs and different funds that we operate out of. These insurance companies are regulated, and they have certain capital requirements that they need to pay attention to. So I think the challenge for us is to harness all the loans that we originate in GSO and in our real estate group, take all the financing that comes out of our real estate activities, our private equity activities, and structure them in a manner that gives the insurance company community this capital efficiency. That's not something that we focused on until we got into this business. And I think we have the potential to be a significant manufacturer of products, primarily investment-grade product, that will be relevant to the insurance community.
That word manufacturing harkens back to the kind of credit product creation that happened prior to the financial crisis and got a lot of firms in trouble. How will this be different?
Well, I think you're referring to structured products.
I am.
And we're focused on whole loans as well as financing products. Just to give you an example, we run lots of different loan portfolios. The leverage that finances some of those portfolios create opportunities to have capital efficient securities for the insurance company community. So I don't think it's exclusively CLOs that are 10 times levered. I think it's going to be a combination of loans that we create out of GSO as we're financing a middle market company. It could be an investment grade company that's in our private equity portfolios. So I think it's going to be a highly diversified pool of securities and instruments that we're able to create that will satisfy these these requirements of insurance companies.
Will you be sourcing credits exclusively inside Blackstone, or can you go elsewhere to find a loan, for example?
Well, I think the secret sauce is things that Blackstone creates and the confidence that we would give to the insurance company client of our good housekeeping seal of approval when we create the security. But we're perfectly capable of going into Wall Street and acquiring or assembling securities in the public markets if we can find them attractive enough to fit our requirements.
And does this mean that the credit products you're currently developing, or at least the loans at the very least, will now be shifted toward insurance and away from something else where they're currently going?
I think it will be additive. I think we'll be able to take this technology and our capital markets people will design structures that will allow us to be more competitive, and we need to, get this into our DNA when we're thinking about structure and financing products. So I think it will do a combination of things. We could create securities that give these insurance companies incremental return and less correlation. They can decide whether or not that benefit gets passed along to a policyholder or it gets passed along to their shareholder. We at Blackstone will have incremental sources of capital that help us finance our day-to-day investing activities.
How important is this effort relative to everything else Blackstone is doing?
Well, I think this is one of the major initiatives that the firm has underway. We recently hired a CEO to lead this effort, Chris Blunt. He's the former president of New York Life's investment group. We currently have about 25 people. He's probably going to grow that over the next couple of years to 35 to 40 people. It gets a lot of focus by John Gray and Tony James. So I think it's a very large initiative on the part of the firm.
And meaningful in what way? How does it shift, say, the balance over time? How does it shift, say, the balance of management fees relative to carry, the two principal ways Blackstone makes money?
Yes. Well, if you take Tony's $100 billion target, once
I think
all
he
that...
said at least.
He did say at least. That didn't escape our attention. Once that's fully deployed, hypothetically, that has the potential to generate $500 million of management fees to the firm, in addition to incentive fees and carried interest. I think $500 million based on 2017 management fees is somewhere in the neighborhood of 10 to 15% of what we currently do at the firm. So that's a meaningful incremental level of revenues to Blackstone.
Over that period of time, will this be the biggest, most important thing Blackstone does?
Not sure it's the biggest or the most important, but it will be significant. It represents the opportunity for us to take 4 great business franchises and create a 5th. We have aspirations of having 6 and 7, but they too will take some time.
So, in addition to hiring people, that's an obvious need, what other kinds of internal changes does moving into insurance require at Blackstone?
So the major effort right now is to get the different investment groups to all work together.
They don't now?
Well, we have lots of collaboration, but what I'm talking about is focusing on these insurance company type products. So we recently created a committee across the different groups. This committee meets regularly, and we talk about the different financial technology that's required so that everyone kind of understands what are we trying to solve for, how do we create attractive investment grade product that fits the asset liability framework of an insurance company, fits the capital requirements of an insurance company, meets the duration, fits within their liquidity framework. And
this is really that different from what you do now?
Very different, yes. Yes, because each group kind of goes out and does its financing activities pursuant to what makes the most sense for its LPs. Now we have a new LP, the insurance community. So we need to get people focused on how does that create a situation where we can redesign the capital structures or our financing activities for what we're trying to accomplish.
Does serving the insurance community at the same time enhance Blackstone's ability as a debt financier?
I believe so. It represents an incremental pool of capital that we're not directly tapping. And if we have more capital potential, a bigger addressable market, we ought to figure out how to make ourselves more creative, drive down the cost of capital, introduce a creative element that makes the overall financing structures more efficient.
Yeah, to your point, does the capital structure of the deals you do change as a result?
I don't think the capital structures will change. I think the components might have different attributes. Instead of designing something that fits the publicly traded syndicated loan market, we might create a private credit alternative that has a longer maturity, that fits better for an insurance company that has long-dated liabilities.
Bennett, how is what Blackstone's doing in insurance different from what Apollo did?
Well, Apollo did a fantastic job creating Athene.
A captive insurer.
Yes. We're all quite impressed with what they did. We're trying to go about it in a different version. Rather than have just one company, we would envision having lots of different insurance clients. And I think all these firms will try to find ways to create products for insurance companies. However, I think no firm has the scale and the array of investment activity that Blackstone does. And what we're trying to do is just harness all that activity to be relevant to these kinds of clients.
Aren't there some similarities with what Apollo did with Athene as well in the Fidelity Guarantee in Life transaction and the Harrington Re situation?
Absolutely. I think Fidelity Guarantee, which our TAC Ops group invested in, has a lot of analogies to what Athene did. I think Harrington Re is a different kind of version. The firm teamed up with Axis. We formed a new company, and there we're managing their general account. In the case of Fidelity and Guarantee, we're managing a sleeve of their general account. And I believe in the case of Athene and Apollo, they have yet a different variation on what they're trying to accomplish.
Now, will getting to $100 billion or more in assets for insurers require more of these kinds of deals? Is that in store?
Well, I definitely think it will involve for us the ability to go out and talk to insurance companies around the world, explain to them what we're capable of doing and how we create value for them, and then signing them up as clients of our new BIS division.
Right. But signing an insurance company up as a client is different from taking an equity stake or partnering with a SPAC, for example.
Absolutely. And I think it will be a combination of all those things. We can create other de novo entities like Harrington Re. We can help Fidelity and Guarantee grow and go out and acquire other annuity-like businesses. So I think we want to have a lot of different levers to pull to try to get to our $100 billion at least target. And it's kind of hard to know exactly how all that's going to play out, but we want to be able to have the flexibility to have lots of different ways to accomplish that goal.
Now, at the end of the day, is it ultimately, or is it simply, let's say, just about creating credit product for insurers, or is Blackstone also offering the outsourced CIO capability?
Well, I think there'll be not just fixed income type products that we offer. I think we'll do an array of things for insurance companies. One of the most important functions I think that we can provide is some world-class risk analytics capability. I don't think that exists for alternatives yet. So, one of the things in the laboratory under the R&D category is to try to sort out how we can do that. How can we help these insurance companies monitor what they own, stress test what they own, plug in different macroeconomic variables, see what that does to the portfolio. And I think that's a very valuable asset to offer to an insurance entity.
Sounds an awful lot like what BlackRock does.
BlackRock does an exceptional job in the fixed income world. This is a little different just because these are primarily private type securities, as opposed to they're not liquid, publicly tradable investment grade debt.
So who does this put you in greater competition with?
Well, I think you mentioned Apollo for sure. Guggenheim is very good as well. I'm sure there are many other entities. Probably Jefferies comes to mind. I'm sure there are lots of other folks. We're not too concerned about who the competitive landscape is. We're more focused on what's the value proposition that Blackstone can provide. How do we execute it? How do we deliver it on a timely basis?
And why now?
Well, I think, one, we're always looking for different ways to grow the firm. The regulatory climate and the compression of yield over the last 5 years has made this more apparent. We started thinking about this 2 or 3 years ago, and I would just say it's the cumulative impact of the things that we've been involved in, Fidelity and Guarantee, Harrington, watching the growth of Athene, got us all focused on how can we do a better version of all that. And I think that brings us to the present time. It's hard for us to get excited about a major new business initiative without having a great leader. So it usually starts with hiring the CEO. So we were able to get Chris Blunt on board in January of this year, and that really crystallized, I think, all the different efforts the firm had underway.
Bennett, why is raising, is it fair to say that raising money directly for credit products, whether it's through these insurance vehicles or something else, better than going through BDCs the way that you were doing at Franklin Square?
I wouldn't say better, just different.
So why exit the Franklin Square relationship?
Oh, well, that's a different question. In the case of Franklin Square, we decided we just wanted to have total autonomy and control over our business, just like every other Blackstone investment activity. We parted ways on a very amicable basis. I think over a period of time, this will be a more profitable business for Blackstone as we capture 100% of the revenues associated with managing these portfolios instead of the old construct where we got 50% of the revenues.
You shuttered GSO's internal hedge fund about a year ago and locked up your client money in a different fashion for a longer period of time. If you look at that today, and maybe it's the same as it was a year ago, is running a special situations or distressed credit strategy with monthly or quarterly liquidity just nuts?
Well, we obviously made the strategic decision that we wanted to have all long-term drawdown type capital to play in the distressed markets. That market is just much more illiquid than it has been historically. And to be able to provide quarterly liquidity is, I think, very difficult in order to sustain your returns.
Yet lots of people are still trying to do that.
They are. We wish them well. The negative of a drawdown fund is the fees are less, and we're okay with that. We'd much rather have a product that gives us the right asset liability type match, and if the fees are less, the fees are less. But it makes us better investors, and that's really what the key is to having that kind of drawdown capital. This market that we operate in is very volatile, and you want to deploy capital at those moments where you have the most amount of distress and the most amount of volatility. That's the time when investors tend to want their capital back. So by having these longer dated drawdown funds, it's just a much more effective way to invest in that marketplace.
Bennett, Blackstone and GSO specifically have attracted some controversy, as you know, over a refinancing that you did for Hovnanian, the home builder. Solus, another hedge fund, has gone to court claiming that the deal is illegal and it's going to damage the credit swap market. In retrospect, would you do the Hovnanian deal again?
Well, there's a limited amount I can say regarding Hovnanian because of the litigation. And we do think that the case is completely without merit.
But that's why I ask, regardless of the complaint, would you structure a transaction similarly, whether it's for Hovnanian or for another company again?
Well, let me say it this way. When we have as a counterparty a distressed hedge fund, we know we're dealing with an aggressive, litigious entity. However, we're very proud of the fact that we delivered to a long-term client a very attractive capital solution that lowered their cost of capital, extended their maturity, lets the management team and the 1,900 employees of Hovnanian stop worrying about their liquidity and their balance sheet and focus on operating their business.
Has there been any fallout for you or for Blackstone, given the fact that banks, for example, are highly interested in the sustainability and dependability of the CDS market?
Well, as a result of this transaction, we've seen no impact on the trading levels of the CDS market. And if people want to change the rules on how these contracts are governed, there's a well-documented procedure for ISDA to do so.
You expect that'll happen?
We do, and we encourage it to happen.
So in other words, this, let's call it for argument's sake, a loophole, will be closed?
Well, you might characterize it as a loophole.
I said for argument's sake.
If people want to change the rules that are written in black and white because they think it makes for a more effective market structure, we're all for it.
Even though it would limit or inhibit your ability to structure transactions similarly?
It wouldn't worry us at all if they changed those rules.
Bennett, how will rising rates affect your business?
Well, we're looking forward to that. Rising rates is going to create volatility, particularly in the high-yield bond market. And we need that dislocation, that disruption, to find new things to invest in. While we have existing investments that might trade down on a mark-to-market basis, we're very confident about the credit quality of what we own, those companies' abilities to pay interest and service their other financial obligations, pay us back at maturity. But what we worry about isn't what we own. It's how do we deploy the $25 billion of dry powder that we have. And in order to do that, we need things to move around.
Your eyes just lit up. How big a correction is the high yield market in for?
Well, we do think the high yield bond market is vulnerable. It's a fixed rate market. Valuations are pretty tight. I would argue they're at T plus 400, they're pretty stretched. A typical high yield bond today yields 6.5%. If the Fed goes forward, their interest rate hikes, that will cause NAV, net asset value, in these mutual funds to go down. That will then create technical selling. That virtual cycle will then cause selling, incremental selling, and that's when we start seeing spreads to widen. So we think that's what makes the high yield bond market potentially vulnerable as we look out over the next 12 months. We own very little fixed rate publicly traded debt in our portfolios. We're much more cognizant of the relative value that syndicated loans offer. You get essentially similar yield, but the benefits of collateral and a floating rate structure that actually gives you a higher yield as LIBOR increases.
So spreads will go from 400 to what?
Look, the historical average for the high yield bond market over the last 15 years is probably about 600 over treasuries. We'll get a lot more active when we see it cross 700.
You think kind of our threshold in the next 12 months?
I don't think it's going to happen in the next 12 months, but it could happen over a 2 or 3 year time frame.
And at the same time, there's a raging debate over valuations in private credit. Where do you stand? Is there a bubble? Are the valuations too stretched there as well?
I think in the private market, you have better relative value than the public market. I think pricing has definitely tightened. Can't deny that. On the other hand, I think you get good value. On an unlevered basis, lending to a middle market company with $75 to $100 million of EBITDA in today's environment, you can probably earn L plus 6 to 650. With a 2% LIBOR, that's kind of an 8 to 8.5% unlevered return for senior secured risk. You're able to collect fees up front for the origination of that loan. You have call premiums if you get called out. If you look at it on a 2 to 3 year yield to first call basis, that's kind of 9, almost 10%. That's good value. Now that was 12% 2 or 3 years ago, but the nature of competition is such when you have a bargain, capital is going to come into that market. But we still think it's a very attractive risk-adjusted return because you're senior, because you're secured.
Bennett, the director's in my ear telling us we have to wrap. One quick, Anthony, my apologies, one last question. If you're right, if spreads widen in the high yield market past 600 on to 700 in the next 18, 24 months, what happens to the high yield market itself? Does it collapse? How much does it shrink? What's the outcome?
Well, it's certainly not going to collapse. And I would also make the observation, there's tons of dry powder out there. And as spreads widen, you're going to find lots of investors coming back into that market. There have been outflows year to date because of the fact that it doesn't look all that compelling relative to other alternatives in the credit space. Prices go up and down. They always do. Over the last 15 years, high yield has crossed that 700 over Treasury threshold 10 times. So it's a regularly recurring thing over a period of time. We've just been in a tremendous period of complacency, and that won't last forever.